You're listening to Economics Detective Radio. My guest today, returning to the podcast, is Kevin Erdmann of the Mercatus Center. Kevin, welcome back to Economics Detective Radio.
Yeah, thanks for having me back.
So our topic for today is, the same thing we talked about last time, back in the distant past, which is your research on the housing market and its relation to the financial crisis and, of course, its ongoing problems. You recently published your book, Shut Out: How a Housing Shortage Caused the Great Recession and Crippled Our Economy, which I'll link to in the show notes page. Tell me, how is the reception to your book so far?
So far, it's been really positive. I'm sort of surprised at how positive the feedback is because there really aren't any oxes that don't get gored along the way, and everyone. I feel like I discovered this. I don't really feel like I'm making an argument. It's more like I discovered this thing that nobody had noticed for one reason or another. So I feel like people are sort of discovering it along with me now, and it's really been kind of fun to share the research.
Yeah, and you've been working on this for quite a while, and when you first started working on it, so I should remind the audience, your general thesis is that, contrary to what the popular belief was, during the Great Recession and shortly after the 2008 crisis, the mainstream view was that housing was oversupplied. There was a bubble because of cheap credit, and people built too much housing, and that was something that led to the financial crisis. Your thesis is exactly the opposite, or somewhat the opposite, that housing was actually severely undersupplied, both during the sort of build up to the housing crisis in the 2000s and also to the present day. And I find that your research has been really influential on me. Like I kind of believed in the overbuilding of housing, back when we were all talking about the financial crisis, and then I sort of pivoted to being worried about housing being undersupplied and skyrocketing housing prices and people being pushed out of places like San Francisco and New York and Vancouver, where I live, by high housing prices. And I sort of didn't reconcile the cognitive dissonance there until I read your work. And, I was thinking, oh, wow, yeah, that is that. There's a contradiction there. And I didn't really think about it. Yeah, I think when you started, housing prices were still depressed. They were down below where they had been at their peak. And so a lot of people kind of, didn't want to hear that housing was undersupplied. But now that housing prices are right back up, your message is being very well received.
Yeah. And that's exactly the sort of thing that I'm seeing everywhere I present the work. I think there's almost sort of a hypnosis that we had, like Bernanke in a report to Congress in like 2011, which is, years after the crisis starts, is still saying that we're working off an oversupply of housing. And if you just look at the numbers, if you look at the scale of what would have had to have happened for that statement to make any sense, that we would somehow manage to build years worth of houses that we couldn't fill, it's sort of crazy. It's sort of amazing that we all went down the path of that being something conventional to say that didn't seem crazy in 2011, right? So yeah, it's sort of like we believed in somehow we conventionally all universally believed some things that were kind of crazy. So once you sort of remove the scales from your eyes and look at it with a fresh look, it just sort of immediately seems obvious, doesn't it?
Yeah, so I guess the thing about the bubble theory is that people were living in all of those homes. And so the idea of a massive supply overhang is kind of directly contradicted by, the evidence of just, looking at all the homes that were built and just look, and they had people in them, and those people needed homes.
Yeah.
And I don't know if the idea is that they should have been renters, or where they were going to live. If it was truly an overhang, where were these people supposed to live in the absence of a housing bubble? Were they going to move in with their parents?
Yeah, exactly. Yeah. Yeah. And, there, I mean, there is some data there was, a little bit of an increase in second homes and that sort of thing. And you'll see people point to that, but the scale of it, that's the thing about it. There's all these sort of plausible, but unverified, things that people talk about, and just the scale of building extra homes, vacation homes, and so the scale that would have had to happen to actually create an oversupply is just far beyond anything that did happen, or really probably anything that could conceivably have happened. I mean, you look at a city like Atlanta or Phoenix, where just on a typical year they're building, inflation, or population is growing 3 or 4% a year, and you think about the quantity of building that has to happen just to keep that flow going. The idea that these are the places that we thought were overbuilding, but the idea that a city like that could possibly overbuild, even if they sort of let everything just go crazy, and just permit as many as they could. You'd have to build 5 or 6% growth a year, for a year or two to get the amount of oversupply that is sort of implied in a lot of the public comments that you see of people talking about what happened in, when looking back in 2010 or 2011. Um, it's actually implausible that those cities could have an oversupply caused by overbuilding. The only way a city like that gets oversupply is because of the sudden whiplash in migration that suddenly cuts off the demand that was just, naturally flowing into the cities for it spiked in those years, but those cities have natural inflow that had been going for years that we've actually cut off, and migration into those cities has been a lot lower since 2007 than even pre-boom uh, flows were. So
Yeah.
we created this huge whiplash in demand, and looking back, you see thousands of homes around town now that are empty and for sale. It naturally, until you sort of explain that away, and go through the details of what happened, that you would naturally come to a conclusion that somebody built more houses than they should have.
Hmm. Yeah. So, people misdiagnosed the what was happening in the housing market prior to the crisis. If people hadn't misdiagnosed the housing market, how do you think policy should have reacted post 2008?
Yeah, in fact, that's the second. I'm in the finishing processes of the follow-up book to Shut Out. That's more of sort of a timeline of, okay, now with this new framework of looking at it, what are the implications for policy, going through this boom and bust? And I think you can sort of describe it as like an avalanche, like a snowball effect. That as early as 2005 or six, just very minor things were happening that were easily reversible, that weren't really creating that much disruption. But the thing is, as it was the policies that were creating disruption, and as the disruption kept ratcheting up, instead of second guessing the policies, so once you get to 2008 and home prices are dropping by 1% a month everywhere, and everything's, all the markets are in panic, instead of stepping back and saying, I wonder if the policies we're creating are causing these panics, and causing this collapse, we just it caused the public to say, see, the bubble was even worse than we thought. See, the lenders were even more reckless than we thought. And so it led us to double down on all these policies that were actually causing the panic. But if you go back to 2000, the Bernanke's first meeting of the Fed in March 2006, in his memoir, he writes about how they were happy to see that residential investment was starting to decline, and they were actually they'd been raising interest rates for a couple of years. They had inverted the yield curve by this point, by their policy rate was up to 5.25 by like June or July of 2006, and they're operating under this idea that there's a glut of housing. So they actually, they're explicitly talking about the 2006 and seven economies looking forward and saying, okay, we're going to lower GDP growth, and we expect the economy to sort of keep humming along, and the lower growth will all be out of housing, and that's good because we've been overbuilding homes, and so this will be, so they're sort of aiming for the soft landing, and they worked. They succeeded in that, and in fact, the iron to me, I think the irony is by mid 2007, on the terms that they had defined it in when they looked at it in 2005, they actually achieved the soft landing. Now, I don't think we ever needed to see a decline in residential investment. If anything, we needed more residential investment in the places that had a shortage. But to the extent that that's what they wanted to do, by mid 2007, housing starts had cratered. Residential investment, had dragged down GDP growth by about 1% a year and was down to, recessionary levels. And it really didn't have any effect on unemployment rates. Or home prices were still pretty stable. They actually achieved the soft landing by 2007, and that was the irony is that was very unsatisfying to the country. The country couldn't stand to have a soft landing because we had canonized the idea that a collapse in the housing market was inevitable. So by mid 2007, I would have conceptual disagreements with the idea that they should be reducing residential investment. But at that point, I think a rational country would have said, operating on the right framework, would have said, we got the soft landing. All right, let's sort of put the gas down a little bit, lower interest rates, goose nominal GDP growth, let housing start to recover again. And today, instead of having this conversation, we'd be having a conversation about why it's the Fed's fault that home prices are still so high, right? Which is this conversation you're having in Canada, right? Because you didn't impose this foreclosure crisis on yourself. So I think it starts that far back, and that's sort of how the snowball gets rolling. And then obviously by mid 2007, when the subprime market collapses, now it's sort of the snowball's getting larger, and at this, from that point, for that next year, the Fed is just sort of chasing interest rates to zero, and and you can see now in hindsight the broader economy starting to collapse, and various credit markets going through panics, and the country being fairly unified in being against the Fed ever actually stabilizing things enough to allow home prices to recover and the broader economy to recover. But I would say probably, so that, of course, that leads to, goes to a head by September 2008 when TARP and all these other things happen. And by, the end of 2008, the start of 2009 with QE, quantitative easing, the Fed is finally committed to stabilization, mostly over the complaints and cries of a lot of pundits and a lot of people in the country. They were calling it bailouts, but they were finally stabilizing the broader market. And the key point that happens there is now we start imposing a housing crisis through credit markets at that point. So what's interesting is at that point, Hank Paulson, who was the Treasury Secretary under Bush, and Tim Geithner, who's the secretary under President Obama, and so those two are sort of, the Treasury is sort of in charge of regulating Fannie and Freddie and credit markets, and they take credit for stabilization at that point. They say, we took, it's September when all this stuff happened, Fannie and Freddie get taken over by the federal government, and their narrative about what happened is that by doing that, they stabilized housing markets, and so everything was sort of much better from that point on. But the thing is, if you from that point on, if you look at markets, basically the high end versus the low end, the high end markets did stabilize in every city across the country, but low end markets after that point collapse, and it doesn't matter if you were in Omaha or San Francisco or Atlanta or Phoenix. It doesn't matter what kind of city you were in. The post 2008 period for the low end of the market is actually the worst part of the housing bust for those markets, and it happens coincidentally with the federal government through regulations and through Fannie and Freddie basically cutting off legal lending to marginal buyers. So anytime during the bubble or before the bubble, the average FICO score for a borrower is around, say, 710. Over the course of 2008, that suddenly jumps up to like 750. I mean, it's like a multi-sigma shift compared to any sort of shift that had happened in the past. We effectively just stopped lending to owner occupiers at the bottom half of the housing market. And when we did that, prices in those markets, the bottom compared to the top of practically every city after that period declines maybe 20 or 30% or more. And that's the period when you see most of the vast majority of foreclosures happens in that late period. So the Fed sort of starts the ball rolling, but the real damage is that post 2008 credit regulations being severely tightened because of this moral panic we had. So the irony is, I think if we hadn't had the credit tightening that happened after the 2008 crisis, a lot of what we see as the results of the 2008 crisis probably would have been much, much lighter, wouldn't have been nearly as severe. And it, ends up becoming sort of a self-fulfilling prophecy.
Yeah, yeah, you can see how even if there was no crisis, how, you know, pulling the rug out from owner occupier at the bottom half of the income spectrum, suddenly saying like, hey, you can't, this huge portion of the population just can't get a mortgage anymore, would probably cause a crisis, even if everything was humming along smoothly. Suddenly
Mm-hmm.
people, can't live in the places where they maybe need to live for to work in the best labor markets. Suddenly they're all these constraints put on them, and then the sort of the way, I think it's not good that housing is the way a lot, most families build wealth these days. It's probably not ideal because they can be so sensitive now to swings in the housing market. But
Mm-hmm. Yeah.
you do that, and then the value of homes comes down, and people who were counting on that as their retirement savings now have to, adjust their consumption, and just like all these dominoes start to fall just as a result of the of this tightening of lending, even independent of everything that came before.
Yeah. Yeah. And I really think it looks like there's an incoherence here at first blush because in my telling, during the boom time, there were researchers who pointed to a difference between low end and high end home appreciation. So in the closed access cities, in places like LA and San Francisco and New York City, during the boom period, the low end of those markets did have higher appreciation rates than the high end. And this is another one of those sort of pieces of information that you can easily characterize that as being caused by loose lending. It seems reasonable to make that jump. Uh, so what I found is actually there's another reason for that happening specifically in those cities, but in every other city in the country, that didn't happen. So outside of this handful of cities where this peculiar thing's happening, from Atlanta to Seattle, prices at the low end and the high end rose together during the boom. There is no difference between the high end and low end. There isn't this signature of credit inflated prices. And but you do see this, during the bust, during this period where credit was tightened so much, you do see the effect of credit where it pulls down prices in the low end in a place like Atlanta and Seattle. So in fact, that effect has been so strong that the low end in Seattle, if you benchmark Seattle and Atlanta to say 1998 or 2000, and you follow and you separate out the zip codes in those cities by home price. So you take the highest 20% of home prices in both cities and the lowest 25% of zip codes by home price in each city. In Seattle, the top and the bottom move together, but they move up a lot by 2005. In Atlanta, they don't move up much at all, but they move together. And then they diverge in each city. And by 2016 or so, the low end in Seattle is converging with the high end in Atlanta. Owning a low end house in Seattle hasn't appreciated any more than a high end house in Atlanta. The collapse that we created through credit markets has been of a scale similar to to the high prices that you see in Seattle that are due to these supply constraints. But that's really it, it looks like I'm saying during the bubble, credit doesn't affect prices, but during the bust, it does. But that's actually conventional financial theory because you look at say Apple Computer. If Apple went private, was owned by a private equity firm, their valuation would probably decline because it's a less liquid market. It's not traded freely. Anytime in if you look at equities, moving from a liquid public market to a private market tends to lower their valuations. And that's basically what you're seeing in an extreme way in these low end housing markets. We've removed liquidity from those markets. We've removed potential buyers, and it's made the price go down. But it's not like where Apple is today in a liquid market. You couldn't really make the price of Apple stock today go any higher by adding liquidity to the market, right? I mean, we could imagine, let's say that you made special rules that anyone could trade on margin on Apple stock with no limits or something like that. You could imagine adding new liquidity to the market for shares in Apple, but that's just going to trigger selling because it's already at the liquid sort of frontier of a liquid market. There's sort of an asymptote to what liquidity can get you in a trading market. So it's actually conventional financial theory that's with more liquidity, you wouldn't necessarily see a huge shift in prices. But removing liquidity does, in conventional theory, lower prices, especially if it's extreme.
Yeah. So just for listeners who might not be totally up on financial terminology, liquidity is the idea that you can easily convert something to cash. So if you have Apple stock, there's a ton of buyers and a ton of sellers in that market. You can sell your Apple stock and have cash immediately in 1 second. But if you have a house, it's not so liquid. You have to, you get a realtor and do open houses, and it could take you a while to find a buyer, and and you're not super sure of exactly. There aren't a ton of identical houses out there, so you don't know exactly what price you're gonna get, and it's a pretty thin market. If you for the specific type of house in the specific neighborhood. And so what you're saying about the reduction in liquidity, that's a consequence of the tightening of the lending market at the lower end.
Yeah. In that case, I would say it's that there's potential buyers that would make a rational decision to purchase homes, but they can't get funding to make that purchasing decision because housing is so tied up in debt markets are an important factor in purchasing homes. We don't buy, we don't sell homes in as shares like we would a company. So it's one equity position and a debt position. And so where debt markets aren't operating freely, then you can lower the market value just because you've eliminated a segment of the market that might be willing rationally to bid the price higher.
Yeah, and I mean, if the market were, if there were a very low transaction cost, you might expect, a an institutional buyer with deep pockets to buy those homes and then rent them to the people who would have been buying them if they had access to these mortgages, but there are barriers to that happening. It didn't. A lot of homes that people should have lived in ended up empty.
Yeah, well, I think this sort of goes back to the comment you made earlier about housing as an investment vehicle, as a savings vehicle. And I think one thing I think it would be helpful to sort of have a different way of thinking about it as an asset class. There's a lot of focus on affordability, on ability to pay, and on having a leveraged position in an asset, and those things are all important. But I think what tends to get overlooked is just the natural value that flows to an owner occupier by eliminating the agency problem of having to deal with
Mm.
a tenant being different than the owner. And in fact, I think you can see this on the ground. When you look at, say, tenant advocacy work, effectively all that work is about dealing with this agency issue, because you have this conflict between owner and tenant that both really have a fairly sacred right that we can't resolve. So for the owner, it's you have property, and our modern civilized economy requires that if you have property, you have a right to do what you want with it, to transact with it as you see fit, to charge the price the market will bear for it. But for the tenant, if the tenant is different from the owner, they also have a really strong right, because the idea, especially for a long term tenant, the idea of the place that you live is really sacred, and that's just as strong a right for them, and you can't resolve that conflict. And so I think it would be beneficial for us to think more rather than thinking of a house as a means for equity growth, or forced savings, to think of it as capturing the benefits of removing that agency problem, which is significant. It really does amount to, in financial, monetary terms, it's easily worth a couple percent a year in return value. You can see that in the value that people are willing to bid houses up to, where credit isn't a constraint. That's why you don't see a lot of rental units in high end markets. And then there's just the practical matter of, when you own the property, you don't have to deal with vacancy, you don't have to deal with bad tenants, you don't have to deal with, there's an awful lot of, like, just managerial expense that comes from being an owner when you're not a tenant. So really, access to ownership, forget all the stuff about capital gains and everything else. There's just a natural, basically, source of excess income from being the owner in that asset class, that comes from having access to ownership. And that's actually, I think that far outweighs all those other factors in terms of why it's important to have healthy home ownership. And I think the closed access problem has sort of made that understanding worse, because having all these cities where we have these people that have windfall gains from owning the right property at the right time and place, it makes it look like capital gains is what it's all about. And so you see a lot of sophisticated people in the housing industry, write papers or articles about how they'll use the phrase like, housing can be affordable or a good investment, but it can't be both, or something like that. And the idea is the only way
Mm.
it's a good investment is if prices just keep ratcheting up and ratcheting up and ratcheting up. And so one generation gets all those gains, and the next generation can't share that. And this is like a widely, believed problem, but it actually isn't. It seems like a problem because we think that that's what's happening in these closed access cities. But it's sort of a weird way to think about an asset. In any other asset, if you sort of clear your mind of these ideas about housing, you would never think that that, say, buying shares in a company, that you wouldn't want it to be cheap to buy, right? Like, things being cheaper make them better investments, not worse. And or with a bond, having a higher coupon rate makes it a better investment, not worse. And it's because we have this idea of the closed access capital gains in our head, but B, because an owner doesn't write themselves a rental check every month, there's not this developed sense of the actual rental value of the house that is the income they're getting from that investment. And that's
Mm.
what it's all about. It's that income, and the fact that their net realized income, both just in money terms and sort of emotionally and morally, by being the owner and getting rid of those agency problems, is just much higher naturally for a homeowner. Now, we've also added a bunch of tax benefits to homeownership that really don't benefit us at all, that just make people that get access, get showered with subsidies, basically. So to me, we should try to get rid of all of those things. But at the heart of it, there's just a natural price point for owner occupied markets that's higher than what the landlord market price is. And so partly that's you could describe what's happening in the low end in all these cities as sort of a one time event of regime shifting, a regime shift in the low end of those cities from an owner occupier buyer's market to a landlord buyer's market where the price point's 20% lower.
Hmm. Right. So a tremendous loss in value from suddenly going from a world where, you can own your home, and if the if you have a plumbing problem, you deal with it yourself, and you don't have all these communication issues trying to call your landlord to get them to send a plumber, and the value, or and they're not having to worry about if you're destroying the home or you're going to move out and then they're going to have to scramble to rent it to someone else. That all
Yeah.
those additional costs come out of this reduction in lending to the lower end.
Yeah. Yeah. And I think, an important facet of that is a lot of the, just estimating the net returns to housing. A lot of the net return to housing comes, there's a pretty big just capital depreciation element to that. And some of that is the air conditioner going out or having a leak in the pipes or something. But some of that is just, say, updating the kitchen every 20 years or something, right? And if you think about it, so if we look at housing, if we look at BEA data and try to figure sort of come to a estimate of what the returns to a typical homeowner are, let's say it comes to 5% a year of net, of a implied return to that investment. Well, about, it's actually more like 7 or 8%. And and we assume a 2 or 3%, depreciation rate. Well, there's a lot of choices for an owner occupier to make with that, to get a higher actual real return from that house. So if you're in a market like San Francisco or something, yeah, you're probably, renovating the kitchen and the bathrooms every 10 or 20 years because your place is worth $1 million. But if you buy a place in a Rust Belt city, where in some of those cities, there's houses that would rent for $1,000 a month that you can buy for, less than $100,000. And, in those houses, those families aren't going to redo the kitchen every decade or two, right? They have that choice. They actually can reap more net benefits from allowing the depreciation of the house and to sort of match the local conditions, right? So there's a lot of ways that owners actually have some control over the cash returns they get from ownership. And I think a lot of that gets overlooked. There's tons of homes in this country, trading in the single digits for, price to rent ratios. Those are clearly positive, for any household that has the potential to functionally act as an owner. There's just no question that if they're a long-term tenant in those houses, that they're better off being an owner. For a lot of those places that, like I said, might have $1,000 a month rent, that you could get a mortgage and have a $300 or $400 a month payment. It's a pretty extreme difference. That's a lot of money you could put back every month for when the air conditioner goes out.
Yeah, that's oh man, I'm sort of picturing the family that pays $1,000 a month, that if they had greater access to credit could be paying $300 a month, or just quite a bit less than whatever they're paying, even if it's just $100. That's a lot for most people.
Yeah,
And just
yeah,
it's the sort of there's great injustice to it that by not lending to people, and I think and the worry was that there was this canonical story about the ninja loans,
hmm
no income, no job or assets. Yeah, that's
yeah,
ninja,
yeah,
right? No
yeah,
income, no job or assets. And the idea that loans were going to people who completely had no ability to pay, and were just taking out the loan just to flip the house or something.
yeah, yeah.
But it seems like that was, you know, It's sort of like welfare queens or something. It's like a story that maybe happened a few times, but
Yeah,
it just wasn't the driving force in the whole market.
exactly. Yeah, yeah, yeah. In fact, in the national data, that's one of the things that sort of led me to this project is one of just looking at raw data from the Federal Reserve Survey of Consumer Finances or American Community Survey, or several of these surveys that are just national surveys that aren't depending on, say, people filling out mortgage applications or something. So you're not getting inaccurate information of somebody trying to qualify. Uh, all that stuff just doesn't show up anywhere. There's no increase in ownership among people with lower incomes. In fact, the new loans were actually focused more on high incomes. In fact, recently I was just comparing. So in the survey of consumer finances, you can compare. They have the average income of renters versus the average income of owners. And in the mid '90s, the average owner had an income of about 120% more than the average renter. So I forget the actual numbers, but if the average renter's income was, say, $30,000 a year in the mid '90s, the average owner's income is more like 70,000. That actually increased during the boom, so that by 2007 it's more like 180%. So by 2007, the average renter is, say, 35,000, and the average owner is closer to whatever that. Actually, the renters probably stayed pretty. It may have still been 30,000 or less, because there's actually a compositional shift of lower income homeowners being the renters, right? So it's probably still 30,000, and the average owner is now more like 70, or what would it be, 80 or 90,000, right? So there was actually a shift toward higher income owners during the boom, and then since then, that's basically stayed at that level. The average owner still has about 180% more income than the average renter. What's interesting is the strict lending doesn't necessarily show up uh, as it. Basically, what you see is the reduction in home ownership is sort of since then is sort of a combination of working class families sort of across the board, and young family. The homeownership rates of young families has gone down a lot, but young families tend to only be owners if they have high incomes, right? So a lot of the strict lending has actually stopped homeownership of people in their 30s with high incomes that don't quite have the down payment or whatever would normally trigger them to be an owner. So the drop in ownership has been across incomes, and so that ratio has stayed about the same. And that's basically what was happening in the boom, was that those young households with high incomes. I actually think the lending market was becoming more, actually was becoming better attuned to finding new borrowers. They were actually finding young households that would have the ability to pay the mortgage. And one way you could look at what was happening during the boom is, home ownership rates went from, say, 64 to 69%. So they went up about 5%, and since then they've gone down. They bottomed out at, I think, maybe 63, or they bottomed out at a little bit lower than what the starting rate was. And a lot of people look at that and they say, oh, there's 64% of the population that apparently is capable of being an owner. We tried to pressure another 5% into ownership who weren't qualified. And so the drop since the bubble is just going back to normalcy. But if you disaggregate by age groups, really what was happening is we were just finding better ways to get young households with high incomes into ownership a little earlier. So if you think about it in terms of age, effectively 80% of households eventually become owners. By the time they're in their 60s, 80% of households are owners, right? So almost every household eventually becomes an owner at some point. Now, normally that may happen at 38, and on average, right? And during the boom, we had moved that average starting age to maybe 37, right? It's like a very minor change to affect, a few percentage points difference in home ownership rate. But those were households with high incomes. Now, the reason we had the ninja loans and everything is because some of those households with high incomes were trying to buy a house in LA or San Francisco where your rent is 40 or 50% of your income anyway. And no mortgage that you're going to qualify for is going to be conventional anyway. So there's no point in talking about your.
Yeah, yeah, and LA is one of these closed access cities. I'm not sure if you've mentioned it, and it's pretty clear. We also talked about closed access cities the last time you were on the podcast, but do you want to just give a quick rundown on your terminology, closed access versus contagion cities? Just what it's an interesting way of putting it. The to word this housing constraint in these cities as what it is, which is a restriction that keeps people out.
Mm-hmm. Yeah, yeah. Yeah, so there's a very distinct group of cities which are closed access cities, which is New York City, Boston, LA, and San Francisco, and San Diego. And there's very little gray area there. Those cities are distinctly different from any other city in that their income growth has been really strong over the last 20 years. Their housing starts are the lowest of any metro area. All those cities build new housing at rates even lower. Things have changed since the crisis, but during the boom, before the crisis happened, they were building at lower rates than places like Detroit and St. Louis were. Um, you know, so there are most economically vibrant cities. They're sort of the centerpieces of the post-industrial economy, and they've capped their populations through housing policies. And so what you end up seeing is these signatures of it actually drives their local incomes higher, partly this compositional effect of just moving the poor households out, basically. But all those higher incomes end up just going to housing costs. So these cities, if you do sort of scatter plots comparing them to other metropolitan areas, they all end up they're all outliers up in the top right quadrant of uh, high incomes but high rental expenses. High rental expenses as a portion of their income. So, for instance, like San Francisco, San Jose, the average income now is probably up to 80 or 90,000, but they spend like 40 or 45% of median income gets spent on rent. Whereas a place like any of the, Omaha or Nashville or any of those cities, the average income is going to be more like 50,000, and they're only spending, say, 25% of their income on. So it's really odd that you would have this situation where places where people are getting richer have to spend more of their income on this basic service. You would expect them to be able to spend less of their income on a basic service, and that's a real signature showing that this is an asset class that's sort of that's sort of the troll at the bridge. That's the people that own those assets own a restricted. They can earn economic rents. They can earn excess profits by owning a restricted asset. And then the other key element that sort of pulls all these things together is that those cities all have this migration pattern for high income households, their inflows and outflows are about even, but they have this just constant outflow of households with lower incomes. They have to move away and go to other cities because they don't build enough houses just to accommodate natural population growth. And because it's all moderated through the market for housing, it ends up becoming, it's the cost of housing that becomes the moderating feature that creates that outmigration. So then the contagion cities are, they're basically the other half of the bubble story. They're the cities in Arizona and inland California and Nevada and Florida. And those cities also had housing bubbles in the 2004 and 5 period. But what makes them different than the rest of the country is that those are the places these migrants move to. So that's why I call them the contagion cities. They basically were overcome by the results of these closed access cities. And so their migration patterns are the opposite. They had a huge in-migration during the bubble, and which has dissipated since. And then, most of the other country is, I would call open access, basically. Among the major metro areas, it's Atlanta and Dallas and Houston that build, that don't really have any macro level restraints on building, so they can accommodate population growth as it comes. And they weren't overwhelmed by the migration, so they didn't have the bubble. And basically every Nashville and Louisville and Omaha and Indianapolis and all those regional centers tend to have that same signature of not having this constraint.
Yeah, so you lose a lot by aggregating the entire country and trying to say, okay, what is the trend in housing? Uh,
Yeah,
y- by singling out, the six big access cities, the ones that are pushing poor people out, and not increasing their housing supply, even while they have, you know, uh, Silicon Valley and San Francisco and these huge windfall booms in certain industries. They're experiencing one story, and the rest of the country is experiencing something completely different. And yeah, that those are the places where young people want to live. People dream about going to a big city and having being part of a large community where you can have a niche interests and meet 50 other people who have the same niche interest, and you can drink at fancy coffee shops and
yeah,
and have that sort of life. And it's
yeah,
just the price tag to do that is just climbing higher and higher, because the number of people who can physically fit into the housing stocks of San Francisco and New York City is just not climbing at the rate that people want to at the same rate as people who want to move there, and as the general growth in population as well.
yeah. I think a real easy sort of way to picture this is to compare Austin, Seattle, and San Francisco. And Austin is, it's becoming quite, a cultural and technological center. There's a lot of opportunities in Austin, but they build, right? The building rates in Austin are like the rest of Texas. And so you don't see that signature. So Austin has a huge, inflow of people, and the average income in Austin isn't hasn't risen far above the rest of the country like these other cities. And part of that is because when the new tech worker moves into Austin, the nurse and the school teacher and the barista and all the yoga instructor, all these other people can move into town with them. And so rents, cost of living is lower in Austin. And so in Austin, you can see, I think, they're probably growing 3 or 4% a year. And so they're building more than enough housing to sort of let all that happen and let opportunity flow. And so you can compare that to Seattle, who does a pretty good job of building. They build above the national average. And in fact, lately, I think they've been allowing, a pretty commendable amount of building downtown. And maybe we're starting to see prices moderate there a little bit. But what's interesting is that, they're not building 3 or 4% a year like Austin. They're building, at a little bit higher than the long-term national average. So in Seattle, they're sort of expanding the housing supply just enough to sort of stay functional. As far as I can tell, we don't have this out migration pattern in Seattle yet. We haven't in the past, and I don't think we're seeing anything develop there. So Seattle's sort of on that tipping point. They don't quite build enough to keep it cheap like Austin does, but they build enough that there are units in the metro area that households can make decisions, to adjust their amenities and location and everything else to find a unit that works for them in the Seattle market. So households can remain in Seattle, regardless of where they are sort of in the income distribution, but housing costs are sort of high there, right? Rents and prices are high, and rent inflation in Seattle is not that much lower over the last 20 years than it is in a place like San Francisco or LA. So then you compare that to San Francisco, and I think you can see, comparing these two cities, where you get that tipping point, because at some point the lack of supply becomes so constricted that marginal family with low income can't can't find a way to make those adjustments in amenities and location to make the metro area work anymore. So as you ratchet down the supply problem, uh, you sort of get a kink in demand. Like at some point, the local demand becomes totally inelastic. Like they can't spend another dollar for next year's rent increase. So what happens is you reach that tipping point where now the signature of your city is this migration pattern happening. And now the only way you get rents to keep going up is by shifting in people with higher incomes that can pay higher rents and shifting out people with lower incomes that can't afford higher rents. So you end up, the problem that leads to is if you compare a place like Seattle and San Francisco, or let's say San Francisco sort of found a sort of a half good way to say, increase their building a little bit, you probably wouldn't see that much of a difference in cost. What you would see would be happening in the shadows, right? What would be happening as a result of, like, let's say San Francisco doubled their building rates. Rents would probably still stay pretty high. I'm not sure it would even reduce prices that much, but what would be happening would be out in every, neighborhoods across the metro area, tens of thousands of households wouldn't be getting that U-Haul and moving out to Las Vegas or Texas or whatever. You wouldn't see the effect because once you hit that tipping point, the effect is, happens through segregation. It doesn't happen through price because there's a limit to what price can, how high price can go without triggering that. And I think those three cities, you can really see the, where those trigger points hit. And one of the ways I sort of phrase it is, and I think this loosely reads in the data, is that basically every city provides about 1.5% growth a year in available housing units. Some cities like Austin go beyond that, and they're not even close to having a supply issue. But whether you don't build a single unit or whether you do add 1.5% of units to your metro area stock every year, 1.5% of units become available. And if you didn't make them available by building them, then they become available by somebody moving away. And so it's interesting over the last decade or so, all these cities that are on that margin, New York and Boston and LA and San Francisco, they all sort of, if there are reasons that people want to move there, if there are population pressures, some combination of price and migration is going to get you 1.5% of units for the people that are trying to get in.
Yeah. Yeah, and I mean San Francisco, like, they're closing schools because there's so few children now because no one who has had children can afford the space to actually, give them a bedroom or something. And
Mm-hmm.
you hear these stories about people who, it's like a mining town where people live eight people in a small apartment, and they stay there for a few years while they earn huge money as a Google engineer, and then they move out to have a family and the rest of their lives. But that's
Mm-hmm.
like their peak earning, and they're putting up with really they're putting up with terrible housing conditions in order to get that huge the cash inflow from working for Google or in Silicon Valley in these really high paying jobs. But they're not there to stay. They're there to work for a while, make some money, and then leave to a place where they can have, a reasonable sized, reasonable living accommodations and a family and all these things, even if they're not earning quite as much.
Yeah,
Uh,
yeah, and you can really see that in the data, like
yeah.
in the BEA data. As a country, we tend to spend about, I think maybe around 12% of GDP on rental expenses, and over the last 20 years, that's been mostly inflationary. It's just spending more, on average across the country because of the effect of these closed access cities. It's just rising rents on, so you can see it in you can see the picture of it in that picture you described of the 8, Google engineers sharing a condo. They're severely restricting their real housing consumption, but their nominal housing consumption's, still high. It's still the same proportion of their income, what they're spending on it probably, but the actual amenities of the place they're living in is much lower than what their parents had.
Yeah, so we're coming up on time. Do you have any closing thoughts, any takeaways the audience should get from this conversation? And you can plug your book because I think people should probably read it.
So the book is Shut Out: How a Housing Shortage Caused the Great Recession and Crippled Our Economy. And you can it's at Amazon, or you can if you sometimes the third party sellers have it at a better price, but if they don't at Amazon, you can go to my blog at idiosyncraticwhisk.com, and the publisher does have a 30% discount. That if there's a code you can see in the top right margin of my blog, if you go to the publisher and buy it, you can get the 30% discount. So it's with that, it's I think $28. So yeah, I encourage your listeners to give it a read. I think it surprised me when, I've spent really the better part of 3 years being perpetually surprised by the by the story I uncovered. So I think anybody that gets it and reads it will share in some of that surprise. Even if they don't follow me all the way 100% to the end of the story, I think they'll find many many little bits of information that will make them think different. Look at the past 20 years with the new framework. Yeah. And yeah, I think we covered the big points today.
And I'm looking forward to you mentioned that it was the first book of you're planning. One other, is it, for the sort of post 2008 world?
Yeah, this book it starts, the timeline really starts in probably 2003 and 4, and I sort of go through the bubble a little bit, and then just step by step through the policy decisions that were made and the public reactions to them, and then in that book I go in a little bit more into maybe some policy prescriptions at the end about ways to make the housing market and the broader economy more more stable and less vulnerable to these sorts of crises. I mean, in the end, I think things like nominal GDP targeting for the Federal Reserve and things like that, sort of at a higher level beyond the housing market, I think sort of allow us to manage the nominal economy in a way where we don't depend on these sort of discretionary decisions that can be overtaken by these sorts of moral panics and pro-cyclical reactions that people can have.
Yeah, so it's housing, and it's central banking, and it's the bubble, and then there's going to be another book dealing with the outcome of the bubble, and sort of more tugging on this thread a little more. And I'm looking forward to reading the first book and to eventually reading the second. So my guest today has been Kevin Erdmann.
Yeah, hey, thanks for having me on again, Garrett.
Yeah, it's great talking to you, and yeah, looking forward to your future research.
Great, yeah.